Now, the clock is ticking on the Philippines' goal to end poverty and become a high-income economy. A new World Bank report warns that without deep, swift reforms, the country could get stuck in a trap of low wages, slow growth, and a stalled middle class. Jin Kim has the details.
The Philippines' vision of becoming a middle-class, poverty-free society by 2040 is hanging by a thread. In its latest report, the World Bank issued a stark warning. Failure to act now could trap the country in a cycle of slow growth, low wages, and poor quality jobs.
Middle-class society by 2040, national ambition. It's not a utopia. It is something that is achievable if there is a commitment, both from the public sector to double down on reforms, from the private sector to innovate and compete.
Over the last 15 years, the Philippine economy doubled in size. But according to the World Bank, it failed to translate into productivity gains. While jobs were created, they were mostly in sectors shielded from global competition like construction and local services, often informal, low-wage, and with limited opportunity for scaling.
3 out of 4 of those, 75% of those, were in non-tradable sectors. And non-tradable sectors are sectors that are not exposed to international trade, international competition. They don't export or they don't compete with imports. We can think the typical textbook example of non-tradables is hairdressers, but we can think about domestic services, we can think about construction. Those were the sectors that created more jobs.
In contrast, sectors that typically boost productivity like manufacturing and exports have declined.
The tradable sector suffered. Another way of looking at the suffering of the tradable sector is by looking at what happened with the number of exporting firms in manufacturing. In the past decade, the number of exporting firms in manufacturing declined by 23%.
Linkages among agriculture, industry, and services remain weak. And even as micro and small firms employ 63% of the workforce, their share in overall output is minimal. Large, high-performing firms struggle to grow, stifled by lack of competition.
Limited competition. And limited competition does not create incentives for top firms to scale up and innovate.
Meanwhile, aspiring investors face a maze of regulatory obstacles, sparking the World Bank's call to dramatically streamline business processes.
It takes 106 days to register a foreign firm in the Philippines. It takes 15 days in Singapore. If you don't reduce that, if you don't reduce the number of days it takes, the processes, the complexity of the processes to register firms, you are erecting unnecessary entry barriers, making investment more costly.
You need 373 government interactions if you want to set up a solar farm. It's a huge barrier to entry. And I'm speaking mostly from the regulatory point of view because that's my experience. But if you even once you get in, let's say you set up your facility and you're running and you've hired people, just the day-to-day interaction with regulators can sometimes be confounding.
According to Varela, if reforms are enacted, GDP growth could rise to 6.8%, an uptick of 1.4 percentage points, and the Philippines could still attain high-income status by 2050. But the private sector warns growth must not be reserved for the wealthy few.
It has to be growth that benefits not just the top, but also the middle segments of our country. And that's a challenge because that's going to take reforms. And I don't know, and I do hope that we have the political will as a country to achieve those reforms. Because if we want to be a wealthy country, and we can be, we really need to grow the middle class. And we haven't seen that in any sustained way, at least not in the last several decades.
The bottom line, the 2040 poverty-free target and 2050 high-income goal will remain out of reach if the Philippines fails to fix its trade, investment, and employment landscape without delay. Jin Kim, Billionaire News Channel.